We'll try it one more time. Let's see. Am I going to come through on this one? Let's find out. If you wonder what I'm mumbling about, is I recorded this afternoon and the sound did not hold. So let's try it one more time. We are going to look at the manual accounting system process that uses subsidiary ledgers and special journals. And let's kind of overview. The general ledger, okay, that's the backbone of your system. That has all your accounts and has all the accounts and all the totals for your financial activity for the company. You have two subsidiary ledgers. One is accounts receivable and one is accounts payable. Now we're adding some new stuff here. They both keep track of the people that owe you, okay? They'll have a record of everybody that owes you, and the people that you owe, your vendors. So your accounts payable has a control account in the general ledger that has its total, but it also has another account, and it's called a subsidiary ledger, that keeps track of each individual client or vendor. You can also have this for inventories. You'll have a regular inventory account that has the total amount, but then it'll be broken down further in another account that shows each item and how much it's worth. So that's kind of what we're looking at today. We're going to look at the general ledger, we're going to look at subsidiary ledgers, and we're going to look at special journals. So here's kind of a wrap-up. We talk about the general ledger, and that's the backbone. That's your chart of accounts. That's your financial totals. That's everything that your whole accounting system beats around that. The subsidiary ledgers support the accounts payable or accounts receivable control accounts that are found in the general ledger. And the AR subsidiary ledger is a customer's ledger, and the accounts payable subsidiary ledger is creditor's ledger or your vendor's ledger. So those are some new terms that we're working with. Now we're going to move and get 4 more new terms. We've been working with a general journal, and we've been putting entries down and posting, journalizing entries to post into the general ledger. We're going to break that one down even further too. Instead of throwing or putting everything in the general journal, we're going to use specialized journals. And one is the revenue journal, another is the cash receipts, and those are your selling journals, and then you have your buying journals, where you purchase items. You've got your purchase journal and you've got your cash payments journal. Now, the revenue journal has all of the revenue that you receive that is received on account. So all of your accounts receivable go through this ledger. The receipt, cash receipt journal is the journal where whenever you receive cash for anything, it is going to be recorded in the cash receipts journal. The purchase journal is going to be everything that you buy on credit. So that's actually going to be everything that goes into accounts payable is going to end up in the purchase journal. Then you have one final journal that you will look at, and that's the cash payments journal. And that's going to be every journal you have, every entry that you do, that you pay cash for or write a check out for. So we've split down just a little bit more and become a little more specified. But what this does is it improves the flow of your financial transactions from your journalizing to your ledger, and you're going to see why in just a minute. You'll also still use the general journal, but the general journal will just be used for anything that doesn't fit in those special journals, such as adjusting entries or closing entries. So here's some examples, and then we're going to work with a little bit some of these. This is how we would record this in the general journal. You'll see we're recording accounts receivables and we're reporting fees, and it's sort of redundant. You write one, this is the accounts and a debit and a credit, and a little bit of redundancy here. If we use a specialized journal, you're going to write the client down here, what the invoice number is, and the total. And you'll do the same thing for wrap, you'll do the same thing for web, and you'll write up accessories again. But you'll notice there's a lot more, this is a lot cleaner. And what happens here is you'll see accounts receivable as a debit and fees earned as a credit. So you're not doing the debit and credit, the actual here. You're going to do it when you get to the general ledger. So this is just telling you, okay, when I get this all totaled up, I'm going to debit and credit these two accounts. Rather than having to post 1, 2, 3, 4 times, you're only going to post once, and it's going to be this total amount right here. And that is going to be posted as fees earned as a credit in fees earned account, and then accounts receivable is going to be a debit. These, okay, also will end up going to your accounts receivable subsidiary ledger. So let's look at this. Here you go. So here are your amounts posted in the subsidiary ledger for each customer has its own card. And then over here it comes, and this is the general ledger where it's posting it in the accounts receivable as a debit, and it's posting it in the fees earned as a credit. See, there's only 1, 2 entries that you make into the ledger rather than, 4? And then over here, you're just transferring this information down so you can keep track of how much each customer owes you. So that's your revenue journal. And let's look at a cash receipts journal. Kind of the same scenario, okay? And this one is going to involve every time a cash debit, because it's a cash receipt journal, so every time you get money it's going to have that account, and typically most of the money coming in is going to be a credit to the accounts receivable because your customers are paying their accounts off. You also have a column here for other accounts in case you have, let's see, like this one's rent revenue. Maybe you rent out a house or a garage or space. So, and this column here can have any number of different accounts in it, revenue accounts typically. So again, this explodes down, and now it's crediting. See how it's crediting? And it's removing the amount of money that they owe you. But you also come over and you post once here to the general ledger for your cash. You're going to post a credit here to your accounts receivable for the amount that adds up here. And you're going to post here for the credit on this one right here. So you can see instead of making 1, 2, 3, 4, you're only doing 1, 2, 3 very clean postings to the general ledger, and you're keeping the accounts receivable subsidiary in balance. So this should always agree with the amount that's in the accounts receivable in the general ledger. You're constantly checking that to make sure that's true. The next journal is a purchase journal, and it's the same scenario. This is when we buy on credit, or we use our accounts payable and we charge it. These, okay, these accounts are the people we owe. This is the amounts that we owe that's going to be credited to the subsidiary ledger on each account. Where we've also got, looks like we made another purchase for office equipment. These were all for supplies. Okay, so this is what we owe. This is what we've bought, the account that we're debiting, and this is our equipment account. Again, can you see how this simplifies things considerably? These will end up individually in the accounts payable subsidiary. Their totals here, here, and here are going to be posted to the general ledger. And again, accounts payable has to agree, the total in this ledger has to agree with the total in this ledger. Very clean. This one is the cash payments, and this is when we pay cash for stuff, and that would include writing checks out. So let's look at this. So we've written out a bunch of checks. Let's see, we had rent, we've had supplies, we've got systems, that must be for consulting, and these are other accounts. Let's see. It looks like, and then these are accounts other than the accounts payable that we have written out. Rent expense was never in our accounts payable, so we just paid that straight up. Utilities expense was never in accounts payable. We received the bill and paid it immediately, which is fine. But these were in accounts payable. When they came due, we pulled them out. We debit this account. We credit the cash account. These come down here and are deducted from each one of the vendors so that our AP subsidiary ledger is correct. And then we post the actual amounts, totals here, to the correct accounts in the general ledger. So you're constantly keeping your subsidiary ledgers current and in balance with the general ledger. And this is what you would pull off. This says the creditor balances are 2410, and in accounts payable we need to have 2410 in there. And we're, like I said, we're always making sure that's in balance. Same thing here with accounts receivable. So it's just a cleaner, easier way, rather than posting to each account, each entry. We'll do it in totals. So I hope this one has a voice to it. So we'll find out here in a minute.